Hey guys, so there's three things I wanted to explain to you guys today. There's been a lot of talk about interest rates going up, and I didn't know if many of you guys knew why this was even important or what these interest rates even mean and how do they even affect you. So right now what I'm going to do is I'm going to talk about the interest rates, and that means I'm going to talk about the prime rate, I'm going to talk about the discount rate, and I'm going to talk about the federal rate. And I hope you guys know what this means, and if you don't know what it means, I hope by the end of this video you guys do know and have a better understanding for what it means. Hey guys, so now I'll talk about the federal rate. The federal rate is just the rate at which the Federal Reserve, they're going to lend money out to those big heavy hitter banks like Bank of America, Wells Fargo, or even a bank like Chase, and they're going to say, hey, well, we'll give you access to capital, let's say of $100 billion, and you're going to pay 1% for it so you can continue to run operations and pay your employees and bring money into the economic system. And that's just all it means when someone says, well, what are the federal rates? Are the rates going up or the rates going down? Now, that does have a direct effect on you because usually companies are going to pass on whatever they're paying for something. They're usually going to pass that on to the customers or the clients or whatever you want to call yourself. But you just want to know that whenever rates go up, that means you're going to pay more for access to your money as well, because that is just going to be passed through to the customers. Now let's talk about the discount rate. The discount rate is the rate of interest that banks lend other banks money at. That just means when Bank of America, they see a smaller bank, they're going to look to finance that bank because it's a money-making opportunity for them. So let's just say me and you open a bank, and it's called the Bank of the People, and we want to get access to capital. Well, we can't just go to the Federal Reserve. We're going to have to go to one of the banks that get their money straight from the Federal Reserve, and they'll charge us an interest rate, which is probably not going to be to the biggest benefit of our clients, because the rate that they charge us, well, we're going to have to at least charge them the minimum of maybe just a little half of a percentage point higher than the rate that they charge, so we can make our money, or we can make our profit back on the rate that they just charged us. So that's just what the discount rate is. It's just the rate at which smaller banks or other banks buy their money from the bigger banks, or from whatever bank loans another bank money, because in some instances Bank of America could buy their funds from a bank like Wells Fargo in case they can't get it from the Federal Reserve at that time and point, or whatever the situation that could happen. But it's not impossible for a big bank like Bank of America to go buy their money from another bank like Wells Fargo. But usually they'll go to the Federal Reserve and they'll get that at the federal rate. But if you're a smaller bank, usually you're just going to go to Bank of America or Wells Fargo, not just those two banks in particular. It could be a Chase, but I'm just trying to use that small example for you guys. And they're going to go get their money from them, and they're going to get charged an interest rate from those guys, and they'll look to make their money in that way. The last thing I want to address was just what is a prime rate. So first, I'm just going to revisit what we talked about. What we talked about, Federal Reserve rate, that's the rate at which the Federal Reserve lends out to big banks like Bank of America and Wells Fargo. We also talked about the discount rate. The discount rate is going to be the rate at which other banks lend to smaller banks. And now I want to talk about the prime rate. The prime rate is just going to be at the rate of interest where the bank lends money out to individuals like me and yourself. And now we all know that at the rate of which they lend it at is really going to depend on your credit worthiness, but we all fall underneath the umbrella of the prime rate because we're not a banking institution. And then that bank, and of course that credit worthiness can affect the rate of which you're lent the money tremendously. You can pay from 5 to 30% interest rate on money that's lent to you. And of course, I say 30%, that's really not even a cap. There's no one that says, hey, you can only pay 30% as a maximum. There's some people probably even paying more than that, but I really don't know too much if they are paying more than that. And if they are paying more than that, they need to get out of that loan immediately and never take another line of credit out again in their lives until they have learned how to manage their finances correctly. That leads me into my next point. Guys, remember, we are running a business, and remember, your personal finances are your business. So if there's an interest rate that is too high in your life right now, you need to figure a way to cut it out of your life, because good companies cut out those high cost liabilities and run your business correctly, cut out those high cost liabilities and minimize all liabilities. For more information about interest rates and how they could affect your portfolio, give me a call at the office at 713-856-5276. Remember guys, you also can send me an email to jabari.king@edwardjones.com. That's jabari.king@edwardjones.com. We'll talk to you guys later.